Bryce Knorr, Senior Editor of Farm Futures Magazine, and welcome to The Buzz for September 28, 2012. It's the last day of trading for the fiscal year, and USDA got the New Year's Eve party off with a bang today. After throwing cold water on the celebration 2 years in a row with bearish September 1st corn stocks estimates, the government stunned the market with bullish numbers today. December corn rocketed limit up in the wake of the news, turning around an awful week for prices. Does this mean the harvest lows are in? I'll discuss the impact for your marketing plan and other report fallout, but first, let's run down the numbers. For corn, USDA pegged old crop carryout at 988 million bushels, 193 million below the estimate made just a few weeks ago in its September 12th report. While the number was just 19 million bushels from my own guess, I must admit I was stunned. Having USDA agree with me is like having my wife admit I've won an argument. In essence, this report means that feed usage of 2011 crop corn was greater than the government's been estimating, which is what we've been saying all along. USDA previously argued that early harvested new crop corn would work into feed rations, and maybe it did. But the carryout number means the nation's livestock industry has only begun to ration demand from pigs, cows, and chickens. Concerns about demand dominated the sell-off headed into the report. Export sales were paltry, just 11,600 bushels in the latest week. But South Korea was an aggressive buyer into the report, with its purchases topping 30 million bushels this week. While it's unclear whether any of those deals will be sourced from the U.S., how end users react to today's report could set the tone for the fall. Supplies of wheat aren't getting any bigger, and the early corn crop from Brazil could be smaller than expected as producers there focus on soybeans. Most foreign customers are short bought, with fewer alternatives available. The next crucial benchmark for the market is USDA's production estimate due out October 11th. While a small improvement in crop ratings suggests yields have stabilized, I'm still below USDA on both harvested acres and yield. As a result, the crop could come in around 10 billion bushels, more than 700 million below USDA. That would set the stage for an even more powerful rally, perhaps taking prices to new highs. But just like my wife is usually right, USDA may be correct on its production estimate too. So producers shouldn't glue their rally hats to their heads. The main goal now is not picking the top of the market, but avoiding big mistakes. This means selling remaining production in increments, as the revenue protection harvest price is set in October, selling the carry into early winter if your own basis is weak. And remember, once that revenue protection price is set, your downside protection from crop insurance ends. So if you plan to hold grain unpriced, be sure to figure out how much you can afford to risk. Buying some cheap put option protection into Thanksgiving, when basis is likely to firm, may be worth it. For one thing, outside markets could still pose a risk to even a bullish market. The U.S. election, European debt, trouble in the Middle East, and the looming fiscal cliff in Washington could all trigger the type of bearish environment that makes investors head to the sidelines from commodities. As for upside targets, with December futures breaking free of its downtrending channel, the first target to come in around the old support line and 50-day moving average around 790 to 795 in the week ahead. USDA had a bearish surprise for soybeans. The government said 2011 crop was bigger than previously estimated by 37.5 million bushels. Yields were raised to 41.9 bushels per acre, up 0.4 of a bushel, with an acreage increase also seen. As a result, 2011 carryout rose 39 million bushels to 169 million. Coupled with the prospect that the 2012 crop is bigger than USDA's last estimate, this puts the bean market in a much more cautious light, increasing uncertainty headed into fall. How big is the crop? Weekly crop ratings suggest it could be 140 million bushels larger than the government's September 12 prediction. If true, That would put an even bigger burden on demand. Fortunately, beans look up to the task. While the market has been worried about sluggish Chinese demand, export sales remain very strong this week. Strong preseason sales suggest USDA could be 200 million bushels too low on its forecast. That's enough to eat through a bigger 2012 crop and the increased carryout from 2011. The question then will be just how strong exports really will be. Right now, my model shows futures have upside to 60.90, $1 or so more than today's market. Whether the market can extend the rally depends partly on how much China buys as their economy weakens. Then the big issue will be weather in South America. Much of northern Brazil is short moisture as farmers get serious about seeding the crop there. My projections for beans don't show a whole lot of benefit from trying to protect the downside, assuming you've already sold a good chunk of your production. So take a wait-and-see approach on your marketings for now. But with deferred futures at a significant discount to November and January futures, don't plan on holding beans past December. USDA's report wasn't expected to do much for wheat, but the agency had surprises there too. Its production estimate went up by only 1 million bushel, but the stocks estimate was 174 million below trade guesses. This implies strong wheat feeding during June, July, and August, but the guess was even greater than I thought. In the short run, this should reduce the agency's carryout estimate for 2012. But these September 1st stocks estimates must be viewed carefully. The agency has a track record of lowering its feed usage numbers in subsequent quarters using some tricky accounting. Wheat followed corn sharply higher, trying to maintain its big spread that's been keeping wheat out of feed channels around the world. Now the question is whether exportable supplies of wheat are tight enough to turn buyers to the U.S. Russia and Ukraine are sold out, giving France and Australia the upper hand right now. French wheat won't last long, and dry weather is threatening the crop in Western Australia. Much of the plains here in the U.S. remains dry for seeding hard red winter wheat as well, which should help the market pick up some steam. Still, with prices above 2012 revenue protection values, this rally is gravy for growers storing old crop. Plan to sell remaining inventory in increments, starting at the top of the September range. Be done if the market can test contract highs. As for 2013 wheat, winter wheat growers have a strong RP guarantee with the sign-up deadline upon us. Focus on getting uninsured bushels priced, but use a trailing stop for cash sales into the market now to give it some room, say 850 Chicago July and 870 in KC. Remember also to sign up for Farm Futures Daily, where we provide more specific recommendations. And be sure to watch next week for another edition of The Buzz.